Valuation. Fundraising. If you're totally new to fundraising, you might not know exactly how valuation works. For example, you might hear another founder say something like they're raising $1 million on a $4 million pre-money valuation. These are the terms on which they're raising capital. Pre-money valuation is the value of the company prior to investment. Post-money valuation, on the other hand, is the value of the company following the investment. When you're selling equity to investors, you're selling stock in your company. You're distributing additional shares based on your post-money valuation. The pre-money valuation and the amount invested determine the investor's ownership percentage following the investment. In the example mentioned earlier, if the pre-money valuation of the company is $4 million and the founder was able to raise $1 million in cash, the company would now be worth $5 million in post-money valuation. The founder is selling 20% equity of their company to the investor. You have a few fundraising options working with early-stage investors. Equity, convertible debt, and investment instruments known as safe agreements are commonly used in the first rounds of investment in Canada and the US.
Talk of valuation makes many entrepreneurs see dollar signs. But how do you determine valuation? Get a range of what your company is worth. As a benchmark, look at comparable private companies. The company valuation must not be wildly unreasonable. The terms that an outside investor sets as part of the funding is calculated into the valuation of the company. The terms can be economic, such as liquidation events and dividends. When considering outside capital from professional investors with preferred securities, ensure you understand how the terms affect the overall valuation. Growth is what the investor will be looking for. The investor will be looking for customer growth. Play within your band. There's no tried and true formula to determine a valuation. Valuations typically fall within a range, which tend to be influenced regionally by supply, demand, and culture. You can maximize your leverage based on events taking place in your business, such as signing an important customer or partner, or reaching a major milestone. There are many nuances to the valuation methodology. Ultimately, it depends on your line of business. Products that are not software or are service-based tend to have specific measurable metrics that help determine the value. And of course, sales apply to all businesses. Investors will look for sales growth, momentum, growth margins, and profitability. You may want to aim for the highest short-term valuation, and that may be the optimal strategy in some situations. However, it's important to prioritize other considerations, such as choosing a funding partner with a very specific and highly relevant skill set that can help your company execute on strategy.